Sarah Martinez is a nurse. Every 2 weeks, money for taxes is taken from her paycheck. She does not have a choice in this. This automatic process helps pay for things like schools, roads, and police. Sarah knows her taxes are important for society. She pays taxes on every dollar she earns from her hard work. However, a different story exists for some of the wealthiest people. For example, Jeff Bezos, a very rich person, paid zero federal income tax in 2007. He paid nothing again in 2011. Another rich person, Elon Musk, also paid zero federal income tax in 2018. This is a big contrast to Sarah, whose taxes are always taken. It is important to understand that these actions are not illegal. This is not tax evasion, which is breaking tax laws. Instead, it is legal tax avoidance. The rich use special rules and ways in the tax system to pay less or sometimes no federal income tax. They follow the law, but the laws allow them to do this. Sarah's tax rate is about 22% of her income. But for the 25 richest Americans, their true tax rate on their growing wealth was much, much lower, around 3.4% in certain years. This is 6 times less than Sarah pays. This shows a big problem. The system taxes money from work, like Sarah's salary, much more than money from wealth, like a billionaire's growing fortune. This is not a mistake in the system. It is how the system works. It lets the richest people opt out of funding the society that made them rich. They use the country's services, benefit from its legal roles, and rely on its people. But they contribute very little to keep these things going. This book will explore how this happens and why it matters. 2. Two different worlds. Jennifer Chen is a high school math teacher. She lives in a city in the U.S. Each year, she earns $52,000. This money places her in the middle class. When Jennifer gets her paycheck, a large part of her money is already gone. The government takes money for federal income tax, Social Security, and Medicare. It also takes state taxes. This happens automatically, every 2 weeks. Jennifer cannot choose to pay less. The system collects taxes from working people like her very easily. In 2021, Jennifer paid more than $9,000 in federal taxes. This was about 18% of her total income. Now, let's look at a very rich person, like Warren Buffett. His wealth is huge, around $118 billion. Between 2014 and 2018, his wealth grew by more than $24 billion. But during those same years, he paid only $23.7 million in federal income taxes. This might sound like a lot of money. However, if you look at how much his wealth grew, it is a very small amount. His true tax rate on his wealth increase was only 0.1%. This means for every $1,000 his wealth grew, he paid only $1 in taxes. Think about Jennifer. who paid $180 in taxes for every $1,000 she earned from working. The difference is very clear. Warren Buffett's taxes over 5 years are similar to what 2,500 teachers like Jennifer pay in just 1 year. But his wealth grew by an amount that would take Jennifer 468,000 years to earn, even if she saved every penny. This shows a big problem with the tax system. It taxes money from work much more heavily than money from wealth. If you earn money by working, you pay a lot of tax. If your money makes more money for you, you pay almost no tax. This is not fair. It means the system is built to help the very rich get even richer without paying their share. This unfairness makes it hard for ordinary people to get ahead, while the rich stay untouchable. 3. How rich people pay no tax. Many people wonder how the richest individuals can avoid paying taxes. They use a smart strategy. It is called buy, borrow, die. This plan helps them keep their money and pass it to their children without paying much tax. The first step is buy and hold. Rich people buy assets. These are things like company shares, expensive land, or art. They buy these things and then they do not sell them. As these assets become more valuable over time, their wealth grows. But because they do not sell, the money they gain is called unrealized gain. The tax rules say that you only pay tax on money when you actually sell something and make a profit. So, if a rich person holds on to their shares and never sells them, they never have to pay tax on how much these shares grow in value. For example, a person started a big company, bought shares very cheaply. Now, these shares are worth billions of dollars. If they sold them, they would have to pay billions in tax. So, they just keep the shares. Their money grows, but they pay no tax on that growth. The second step is borrow. If rich people do not sell their assets, how do they get money to live? They borrow it. Banks are happy to lend money to these very rich people. This is because the rich people have a lot of valuable assets as a promise for the loan. For example, if someone has $1 billion in company shares, a bank will lend them millions of dollars easily. This money from the loan is not seen as income. Because it is not income, it is not taxed. So rich people can get large amounts of cash for their living without paying any taxes. They use this money to buy homes, go on trips, and live a very nice life. A famous person who owns a car company uses many of their company shares to get huge loans. This way, they get billions in cash without paying tax on it, while their shares continue to grow in value. The third and final step is die. This step happens when the rich person passes away. When they die, their children or family members inherit these valuable assets. There is a special tax rule called stepped-up basis. This rule means that all the money the asset gained while the rich person was alive disappears for tax purposes. It is like the asset's value is reset to its current high price on the day the person dies. So, if the children then sell the assets, they do not owe any tax on the huge profit that the parent made over many years. The family keeps all the wealth tax-free across generations. This rule lets billions of dollars pass from one generation to the next without ever being taxed by the government. This buy, borrow, die strategy is a main reason why very wealthy people can become even richer without paying federal income tax, unlike most working people. 4. More rich people's tricks. Rich people have even more ways to avoid paying taxes. These tricks help them keep more of their money, often at the cost of public services. One big trick involves giving money to charity. Most people think of charity as a kind act. For very rich people, it can also be a clever tax move. Imagine someone owns shares in a company. They bought these shares for a small price, but now they are worth a lot more, perhaps $100 million. If they sell these shares, they would have to pay a large tax on the profit. But if they give these shares to a charity, they can get a big tax deduction for the full value of the shares. This deduction lowers the total income they are taxed on. In some cases, the tax savings from this donation can be more than the actual cost of the donation to them. So they look generous, but they also pay much less in taxes than if they had just sold the shares. This means the public helps pay for their charitable gifts through less tax money for the government. Another special rule that helps the wealthy is called the carried interest loophole. This affects people who manage big investment funds on Wall Street. These managers earn a lot of money from the profits of the funds they manage. Instead of this money being taxed like a normal salary, it is taxed at a lower rate, like money earned from investments. This lower tax rate is meant for long-term investments, not for work income. Because of this loophole, a fund manager who earns many millions of dollars can end up paying a lower percentage of tax on their earnings than a regular teacher pays on their much smaller salary. This special rule is very unfair to working people, but it has stayed in the tax law for a long time. Lastly, rich people often use personal luxuries as a way to pay less tax. Think about a private jet. For a very rich business owner, this jet is a personal luxury, making travel easy and fast. But they can claim the jet is a business expense. This means the cost of buying the plane, fixing it, buying fuel, and paying the pilots can be written off. When a company writes off these costs, its total taxable profit becomes smaller, so it pays less tax. Even though the jet is used for personal trips too, the government treats it as a business cost. Other items like expensive dinners, fancy cars, or big homes can also be claimed as business expenses. This blurs the line between personal fun and business needs, helping the wealthy avoid paying taxes that normal people would have to pay on such expenses. These methods show how the tax system has special rules for those with a lot of money. 5. Big companies pay less tax. Big companies, just like rich individuals, have found smart ways to pay less tax. They use their size and reach across the world to move money and avoid taxes. This chapter looks at how some of the largest companies do this. One famous example is Apple. For many years, Apple used a complex method called the double Irish with a Dutch sandwich. This was a way to shift profits to Ireland. Apple set up special companies there. When people bought an iPhone or a MacBook in countries like Germany or Japan, Apple's local offices would send money to the Irish company as a fee. This made it look like less profit was made in the countries where the products were sold.
The trick was that the Irish company then paid almost no tax on these profits. In some years, Apple's tax rate in Ireland was as low as 0.005%. This helped Apple save billions of dollars in taxes. Later, the European Commission, a big group in Europe, said that Apple's deal with Ireland was not fair. They asked Apple to pay a lot of money back in taxes. Google, another very large company, used a similar method. Google moved billions of dollars in profits to Bermuda. Bermuda is a country where companies pay no corporate tax. Google used a network of companies in Ireland and the Netherlands to send money to Bermuda. This meant that Google made huge profits from people using its services in Europe, but it paid very little tax in those countries. In 1 year, Google moved nearly 20 billion euros to Bermuda, avoiding taxes on that money. In 2014, some secret papers came out. They were called the Luxembourg Files. These papers showed that hundreds of big companies had made special, secret tax deals with Luxembourg, a small European country. These deals allowed companies to pay extremely low tax rates, sometimes just 1% on their profits. Companies like Amazon, Disney, McDonald's, and Nike were among those that used these deals. This showed that tax avoidance was not just for a few companies, but a common practice for many large global businesses. It revealed how companies could choose where to pay tax and get special low rates. 6. How companies use their power. Companies do more than just find ways to pay less tax. They also get financial help from the government. Sometimes very big and successful companies, despite earning billions in profits, pay no federal income tax at all. Even stranger, these same profitable companies can also receive billions of dollars from the government. These payments are called government subsidies. For example, a large online retail company that made billions in profits paid zero federal income tax in 2017 and 2018. During those same years, this company received hundreds of millions of dollars from the government for its warehouses and data centers. This creates a strange situation where very successful businesses are not paying their share for public services, but they are still using public roads, public utilities, and a workforce trained by public education. They benefit from these things without contributing back.
To make sure laws help them, companies spend a lot of money. They spend billions of dollars each year to talk to politicians and lawmakers. This action is called lobbying. The goal is to shape tax laws in a way that benefits their businesses directly. They invest huge amounts in this activity because it pays off. For every dollar spent on lobbying, companies can save many more dollars in taxes. For instance, the medicine industry and the oil and gas industry each spend hundreds of millions of dollars on lobbying every year. These investments help them get special tax breaks and benefits. This spending changes the tax rules in important ways. The tax code becomes very complex, filled with many special parts, often called loopholes. These loopholes are specifically designed to give special advantages to powerful industries or large companies. They allow these specific businesses to pay much lower taxes than ordinary people or smaller competitors. The tax code is not just complicated by accident. It is often made complicated on purpose. This complexity helps to hide the special deals that corporations have negotiated for themselves. It ensures that powerful companies continue to save billions of dollars. So, companies use their money and influence not just to avoid paying their fair share of taxes, but also to get direct financial help and special rules from the government that are not available to everyone else. This system means that the public pays for services that these companies use for free, and sometimes even get paid to use. 7. The people who help the rich. Chapter 7 talks about the people who help the rich. These are the enablers. They are smart lawyers and accountants. They get paid a lot of money, sometimes millions. Their job is to find or create ways for rich people to pay less tax. They invent very complex plans that follow the law but help clients avoid taxes. These plans are like special tools for money. Many of these experts used to work for the government. They helped write the tax rules. Then they leave government jobs and work for private companies. This is called the revolving door. Because they know the tax rules so well, they can help rich clients avoid them. For example, people who worked for the Treasury Department, which makes tax rules, might later help companies pay less tax. Also, lawyers who worked for the IRS, which collects taxes, can later help rich people fight against tax demands. This gives rich clients an unfair advantage. There are also special wealth managers and private banks. These groups work only for very rich people. They help hide money and manage it in secret ways. They can set up bank accounts in other countries or create complex trusts. These trusts make it hard to see who owns the money. Their goal is to protect wealth and keep it from being taxed. They offer services that normal people cannot get. Some of the clever tax plans are like products. Law firms spend a lot of time and money to create new ways to avoid taxes. They give these plans names like basket transactions. Then they sell these plans to many rich clients. This means that brilliant minds are focused on finding tax loopholes instead of other important things. The rich have an advantage because they can pay for the best legal and financial help. When the tax agency checks a normal person, that person might only have one accountant. But when the agency checks a very rich person, that person can hire many lawyers and accountants. This creates a different system for the rich, where they have more power and can get better results. It means that rich people can often find ways to follow the law while still paying very little tax. They are protected by a wall of special knowledge and high-priced help. 8. Is the game fair? We have looked at how taxes work. For many people, like a nurse or a teacher, taxes are taken from their pay automatically. They cannot avoid it. But for the very rich, the rules are different. This system is not broken by accident. Instead, it seems to be made in a way that helps the wealthy pay much less tax. Rich people use special ways to avoid taxes. They buy things like stocks and never sell them. This means they do not pay tax on their wealth as it grows. Then they borrow money using these things as a promise to pay it back. Loans are not taxed. When they die, their children can get their wealth without paying taxes on how much it grew. This is called buy, borrow, die. It means their wealth can pass from one person to another without being taxed. Big companies also find ways to pay almost no tax. They move their money to other countries where taxes are very low. Companies can make secret tax deals with governments. They also spend a lot of money to talk to politicians. This helps them make tax rules that benefit their businesses. They can even say that luxury items like private jets are business costs to lower their taxes. Many smart lawyers and accountants help the rich and big companies with these plans.
Sometimes, people who used to work for the government writing tax rules then work for rich clients. They use their knowledge to help avoid those same rules. This makes the system even harder to change. This way of doing things is not fair. It hurts people's trust in the government. When the richest people do not pay their share, it can harm democracy. It means that the promise that everyone helps pay for society is broken. Other people who are not rich must pay more. They have to pay for roads, schools, and hospitals that everyone uses. This makes us wonder, what do you think should change to make the tax system fairer for everyone?
Hey there! Just a second before you go. If you learned something new today, please give this video a like, write your thoughts in the comments, and subscribe to the channel. It only takes a second, and it really, really helps to create even better English videos for you. Your support means the world. Thank you.